The good, the bad and the ugly. First up today, we'll hear from some professionals with great track records in our keynote panel, The Good, the Bad and the Ugly. It's my great pleasure to introduce your moderator. First of all, he hails from my hometown of Perth. Second, he has extensive experience with acquisitions, divestments and financing in the mining projects, and in fact, 18 years as founder of PCF Capital Group. And thirdly, for all of us whose weekends are spent ferrying our kids across sporting matches, including soccer, he also finds time to give back to the community as chairman of Football West, the peak soccer body in Western Australia. For the good, the bad and the ugly, please welcome moderator Liam Twigger from PCF Capital. Liam.
Thanks very much, Andrew, for that lovely introduction, and it's great to be here, ladies and gentlemen. The good, the bad and the ugly. We have three members on our panel, and I'll let you use your discretion as to how you apply that, the good, the bad and the ugly. Just kidding, just kidding. Now, in terms, by way of background, we've got to volunteer. By way of background, so quality projects and news flow drive mining company stock values. But from an investor's perspective, good management teams can make the biggest difference between owning a company, owning a stake in a company trading at a premium to its peers and one struggling for recognition. Strong management ensures companies survive during the bad times but also rise to the top in the good times. So what exactly constitutes sound management these days? Who are the names that people look up to and why? Now, before I go into some questions, I'd like to introduce our panel. First on my left here is Joe Bishop. Joe worked in exploration in the 1990s before completing a degree in mining engineering and finance, spending 15 years at the Millionaires Factory at Macquarie Bank, and more recently as an investment professional at Resource Capital Funds in Perth, with a focus on higher returns and earlier stage investments. Next, we have an addition to our panel, and a late addition. We had a change in the lineup, and we're absolutely delighted to have you, Bob. We're very, very lucky. And Bob Schaefer is a geologist and director with Cardinal Resources, has over 30 years' experience, and as I said, very well credentialed. He's incoming president for the Society for Mining, Metallurgy and Exploration, and he was on the board there for 10 years. He's a member of the Board of Governors of the US National Hall of Fame and a Board of Directors of the Canadian Mining Hall of Fame, and I don't think anyone's held those two positions or been able to represent those two bodies, as well as were you president of PDAC as well?
Yes.
Fantastic. But you haven't made it to the Australian Hall of Fame.
Working on it.
Working on it, yeah. We're a little more selective, mate. Only kidding. No, we'd love to. No, all good. So, and then we have Hedley Widdop. A surname Widdop has a long history in the Australian resource funds management business. Hedley is a geologist and works at Lion Selection, a fund that invests in pre-production juniors. So there we have it as our panellists. And my first question I'll ask here, then I'll come and join you over on the chairs. First one to you, Joe. When considering an investment in a junior, how does your organisation think about management, I guess in terms of DD and alignment of goals and capacity? How do you assess management?
Sure. We try to be proactive about it. We're fortunate to have a fairly extensive network within our organisation. So we ask colleagues and then even go further and actually reaching out to people in the industry, not just looking for sort of superficial comments about he or she are good at their job, but really specifically when have things gone right, when have things gone wrong, what are their strengths, what are their weaknesses, and we try and consider this in the context of the whole management team. We're not just looking at an individual. We're thinking, how do these group of people, balance each other out? What do they bring to the table? And possibly, depending on how much capital we're providing, what is the extent of our influence? We might look to supplement a management team, an existing management team, or board of directors with, if we can identify a gap, then we'll try and work with the company to say, hey, we'd like to see this gap filled. And we also focus on the alignment of interests, if you like, to make sure that management and shareholders are incentivised in the same way. So yeah, it is something we put a lot of work into internally, and we've got Excel spreadsheets that try and quantify things, and so we look at it from a lot of different angles.
Great, thanks, Joe. Hedley, would you have a different approach or a similar approach at Lion?
Pretty similar. I think you can apply some pretty quick rules to people, and Joe, I think, has touched on those there, going through your networks and whatever else. When you're backing someone with an investment that you're going to have to keep in there for more than sort of T+3, you need to be able to know them, like them and trust them. one way or another. Deeply, if you can, on all three of those. And they're the simple rules that we apply to people. And I think for any long-term investor, whether it's a little amount of money or a lot, that's pretty important to be able to do that.
Great. No,
Yeah.
I guess...
I was going to say, I've been approached answering the question from the other side of the equation, from the guy that's putting together the management team as perhaps a junior miner or junior explorer. And it's, don't just look to your mates to be your associates on the company. Don't look because you work well with and know this fella to be your CFO because he can work an Excel spreadsheet. Look to and draw upon your network across the entire industry. Find people that match the skill sets that you require rather than just trying to reward a friend for what they've done.
Yeah, thanks, Bob. I guess an extension, Hedley, and the market mantra, I guess, has moved, and we had that sort of massive, really big downturn following the GFC, and from 2011 to 2015, I guess I referred to it as the nuclear winter. Mm-hmm. And during that time, there was a focus on yield, security, and liquidity. You know, the last thing that you find in the mining sector. But when we come out of that, we saw capital available and for growth opportunities, and companies like Northern Star, Revolution, and Westgold sort of went forward and made some once-in-a-lifetime acquisitions. But outside of that, and more recently, I think there seems to be a lack of confidence amongst junior management teams in making acquisitions. And what do you think makes a good management team, and what should management teams be looking for in a project?
I'm going to give away a secret here and acknowledge that we actually swapped a few notes on what we might talk about. And knowing that this might come up, I thought I'll think about it on the plane, because good management team, that's easy to answer. So for the hour and 28 minutes going from where we were touching Melbourne Airport to touching Sydney Airport, I still hadn't finished thinking about it. It's there's a lot to it, right? And then on the train, which was approximately 14 minutes, I tried to condense that down into 1 or 2 points. So just a premise where, you could spend a whole discussion on this. Good management teams, I think, need to have complementary skill sets. And I mean, they've got to match temperaments as well. So, where there's a gap of aggressive of one person, then match that with something that counteracts with another person, if it's at all possible. I mean, if you're picking a dream team, right, you can pick Patrick Dangerfield and Gary Ablett and pay a fortune for them to kick goals from the midfield, but still not winning as many games as the team that was nobodies 3 years ago, right? So it's not all about being superstars and having massive superstars on your team. I think the other thing, and specifically for mining, but exceptionally for juniors, is they need to know the business absolutely back to front. And I mean that across the management team, not one individual who knows the business. And there are good examples of people who do that, but the better people are surrounded by people who also know the business well, so that between them they can have a good, robust conversation about what needs to be done. And I think probably one of the things which really enlightens people to me in terms of being a great management team from just a concerned management team is when they have some form of leverage to the outcome. The Romans used to make their bridge builders sleep under the bridges. I'm a big believer in people owning stock in what they're putting together. So I think between knowing the business thoroughly and having the temperaments matched are a great recipe for success.
Yeah, that's... sorry.
And I suppose the second part of your question then was what should they be looking for in a project? And I think that's specifically from the juniors' point of view, right? Because there's been companies which have been built and they've obviously selected well. So what should juniors be looking for to do that? I think it needs to be something which has a strong value proposition to them, first and foremost. There's no point buying a project just because it's big or just because it's in a specific commodity space. You've got to have a very strong sense as a management team that you can get your arms around it, you can fund it, and that you can see that you can make money from it. There are lots and lots of projects transacted, progressed through assessments, etc., etc., and I'm afraid you can't necessarily always see that as an outcome. So I think for anyone looking for a project, and I think we will probably get to this later, how people have been successful is by having those things very front of mind when they're looking at something. One of the previous CEOs of one of the big global mining companies who was present through a phase of growth, heard him say over a lunch once, when you're looking at projects, you're kissing frogs, right? You've got to wait until you find a prince. You can't just fall in love with the frog. And far too many juniors find themselves continuously kissing a toad. And
I've sort of got the contrary view at times when we have a lot of companies looking for projects and they're looking for Brad Pitt. You know, they're looking for it to be a Hollywood, when if you can get your market timing right, you can get by with a Bart Simpson.
Yeah.
And that's
Well, I think that's true, but remember, I suppose it's from the context of if it's a management team who can shoot the lights out, then they can probably aim very big and they can save themselves for, can I say Angelina Jolie rather than Brad Pitt? But
yeah, but don't use the Bart Simpson equivalent, you'll get yourself in trouble.
But then, you know, there are other management teams who perhaps they bring something very strong to a smaller project, and between them they think they can manage something small, which is a different out-of-the-box concept as well. So it's got to be something that that management team feels that they can get their arms around, and I think that's always going to be the important thing, because if you had Brad Pitt coming along and I'm going to go way off the analogy here, so I won't bother. It's got to be something which that management teams feel they can grasp. If they've got a deep background in gold and they decide to go off on a coal adventure, there's all sorts of pitfalls they're not going to get, even though they're probably very good at managing in the space that they're in. So I think it's probably a bit more specific than looking for your Brad Pitt. You know, you might find something which is very attractive to you. And believe it or not, there's ladies out there that don't think that Brad Pitt's that attractive. So, you know, maybe the Incredible Hulk to them, right?
Well, now I'll get some other feedback from the rest of the panel, but just on that, I guess you see the likes of, you know, companies like Northern Star and Evolution and Westgold and Saracen have been so successful making these acquisitions, and now and they did that during the downturn when they had cash. And now it's unusual. There's projects available and there's capital available, but there just seems in the leadership that's out there, there seems a reticence and a hesitancy to step up and to try and do a deal. And I find, you know, we're a seller of hope. I'm a seller of projects. That's what I do for a living. We find that hesitancy, and quite often, you know, they're looking for. I'll go back to the Brad Pitt. They're looking for, you know, the number one when you just need to get in the game. Mm-hmm. And there is a liquid market for projects out there. You know, and Evolution is the greatest example of that. You know, how they bootstrapped themselves up. They had some good projects, but they had some, you know, average or tier 2, tier 3 projects, but they wanted to get in the game, and they backed themselves to get the timing, the cycle right, to be able to lower the operating costs and to find more gold. And you know, Jake's done a fantastic job ticking all of those boxes. And then you trade the projects, you know, the tier 2, tier 3. But unless you make that leap and have a crack, I guess you'll never get off the bench. And that's what I'm trying to entice when we're sort of dealing projects, is to get people, guys, it doesn't have to be a 10 out of 10 project. You can get by with 6 or 7 out of 10. And then you break yourself away from the pack. You get some market attention. They see that you're out there trying to swing a punch. And you know, you're not going to make a knockout unless you swing a punch. And you've got to swing a punch, you've got to step out. So I guess it's easy for me to say because I'm selling and I don't have to live with it. But it's just trying to entice the juniors out there. What do you think, Bob?
Oh, I can talk from experience. And I'll go right to the evolution issue with the Cowell acquisition.
Yeah.
Yeah, I thought they overpaid for it. I was in the bidding process as well. The way the team that I was working with was assembled was basically, it was an investment bank that assembled us together to carry out the valuation, to place a bid forward, and they had a lot of courage, I thought. They placed value on ounces under the lake that were not permitted, were not delineated, and we weren't going to do that. So sometimes you have to take a leap of faith and have some courage, but at the same time, depending upon where you are in the market cycle, you've also got to exert caution. I was going to go to the people involved. If you're assembling the management team, you got to put your own ego on the shelf. I always look for people that I think are smarter than I am because they can make me look better, first of all, but also I know we won't be making mistakes as a result.
Yeah, I might pass to Joe, but just on that, and I think there are some Evolution people here at the conference, so we've got to be mindful, but I think even Jake has said it himself. I think he recognises, because he lodged the bid on the Friday, and then the Saturday morning it called in by the vendor saying, you know, come in, and they signed the deal. So I guess he realised that maybe he was ahead of the pack by a reasonable distance. But I think when you speak with him, he says, well, I looked at my company without Cal, and then I looked at it with Cal, and we had to redefine ourselves. We needed to get ourselves to tier 1, and we needed to make that sort of acquisition. And he backed himself to find some more gold to lower the costs. Yeah. And to get this timing right, and you know, in hindsight, it was a spectacular buy.
And the difference, I was looking at it as a foundational asset versus a supplementary asset.
Yeah. So there's different drivers. Joe, do you have anything to add there?
Yeah, I'd say management teams have to play to their strengths, and they don't have to try and knock the lights out on the first go. Just sort of averaging up is a valid strategy, but they've just got to keep moving. They've got to have a plan and keep trying to improve their position over time. It's gonna be a long-term game. You can't expect that overnight success.
Yeah, exactly. Now, look, I'm happy to take questions from the floor as we go. So if someone does have a question, put your hand up, and we'll I think Isabel's got the microphone. So as we go along, if you've got a burning question, stick your hand up. Otherwise, we can look towards the end. But quite often, if there's a burning question, it's best delivered on the spot. And we've just got one over here. It's Barry.
This whole idea of the juniors, there's a great dichotomy between what I call my terrific 10, which is the Northern Stars, the Evolutions, etc., and the 100 odd other wannabes and hopefuls. I think clearly the strategies of Northern Star and whatever is to grow organically and look at bigger things, and they're very, very conscious of their rating in the market. So they're being very careful about what they do. When we come down to the other side, everyone's got assets which they know are worth a hell of a lot more than their share price, and because an acquisition or a corporate acquisition merger is going to involve equity, people feel quite reluctant about diluting their own equity at such discounted prices, even though they're would be buying assets at a discounted price. So I get the impression from people in those smaller companies that they are unwilling to dilute themselves. Does that sort of come true to what, as you see things too?
Well, yeah, look, it's a balance. Prices are cheap. Generally, equity is cheap as well, and you've got that dilution, or prices become expensive and equity gets, I guess, a little overvalued. But at some point, you need to take the plunge. But it's an issue we have at the moment. I've never seen such an array of juniors. I've got, there's parties prepared to fund them, but they don't want to overpay for these projects. And I say, mate, you just got to take the plunge. I think the cycle's got 3 years to run, and we'll talk a little bit about the cycle in a moment. And you've got to get in and do it because, to differentiate yourself amongst your peers, I think you need to step up. But it's hard, Barry, and I haven't got a magic solution for that. I don't know whether any of the panel do. No. Very good question.
Just don't fall in love with the asset and get over exuberant.
No, that's right. No, you don't need to fall in love. Agreed.
I think to your point too, Liam, it's never going to happen if you don't start somewhere, right? So, but this hesitancy as well. I mean, a lot of people have seen the example of Evolution and Northern Star, and they have done so many things right to get to the point that they're at. I would say they're afraid of not doing those things right, and paying for an asset now, something which might be, a tenth of the asset, but maybe half of the price that was paid for something down the track a little while ago. And as you well know, as the price goes up, then the risk does too for you to be able to get that right. Doesn't mean you shouldn't start, but I can see what the hesitancy would be if that was it.
It is. When you've got once in a lifetime sort of bargain-based prices, and then you're comparing new acquisitions back to what you paid. Well, you'll never do another deal, so it gets very hard.
Yep.
And then you've got the newer guys that have got to pay a fair value or over and above what everyone else has paid to get in the game. So no, it's not easy. Otherwise, everyone would be doing it. But we move on. Joe, in your experience, where investments have gone really well or really badly, how much of this is people-driven? And specifically, and I think what the audience would love to hear is, what lessons have you learned?
I'd say that success outcomes, that's a combination of luck and good management. When things have gone really well, then there's generally been an element of exploration success or sort of superb market timing, and it can be put down to luck. But I think often the blood, sweat and tears that lead up to that can be forgotten, and good management teams do sort of get themselves in the position of being lucky. When things have gone badly, it's generally started with things being difficult, but it's often difficult for everyone. I mean, it's not an easy industry, but where things have gone even worse is poor management just aren't able to sort of turn things around and respond appropriately. So good management will make the best out of any situation, where poor management will probably generally make a bad situation worse.
So any formative experiences you can expand on or not for you?
On a no-names basis? Well, yeah, I mean, pick a. It's probably often a difficult country, comes to mind, where a geopolitical situation has just turned around, quite quickly, and often at that point it's just also about salvaging as much value as you can. Maybe there's been a coup or an election, some change in policy, which really just means it's a matter of kind of getting out. Things are sort of getting too hard, and an ability to sell an asset at sort of some reasonable number of cents on the dollar and come up with a plan B is, they're the guys that if you can go through that experience and they're still sort of honest with you during the process and take you along on the journey and aren't trying to cover things up and are listening to you, as us as an investor, that's sort of the best we can hope for is sort of transparency and being open to listening to our views. That's a good outcome, or the best of the worst outcomes.
That's a nice segue maybe to Bob operating in West Africa. Have you got anything to add about management teams and the things they need to take into account?
Actually, where I was going was when I'm involved with due diligence evaluations and so on, I generally assemble a risk matrix in which I look at each of the components that go into a project: geology, the engineering side, processing, the community, the government, and so on. And I look at where I perceive it to be presently. What's a black swan scenario where everything just turns tits up, and what's my upside to it, and try to measure those out.
Yeah.
And as it might apply to West Africa, most of the time it revolves around geology is good, so it revolves around how the government reacts to what you're doing. And sometimes legislation changes that was not anticipated, and you may have had a prearranged agreement with the government to stand still on a variety of things, but it can go out the window as soon as a parliament changes as well.
Exactly. So my next question to Hedley, and this is something I think Lions Selection has been at the forefront for a long time in terms of the investment clock or the market clock, in terms of recovery, boom, bust. I think everyone here would love to know, where are we at the cycle? Have we got another 3 or 4 years to go? Can you enlighten us?
I definitely think there's at least 3 or 4 years to go. And it's very hard to be precise about, right? Because in 2009 we thought, well, there's 10 years to go. And there wasn't, there was only 2. That caught a lot of people out, I suspect. What we've seen, and the clock goes from 12 midnight, which is the start of a bust. 6 o'clock is when you come back into the boom, and then up you come again to the next bust. And these things have gone on as long as people have been buying stocks in miners. They've been going up and down because of the flow of money coming in and out of the mining space. 2016, as you said in your intro, we came out of that bust, and I think it was about the 21st of January was the base. And that coincided fairly closely in time to, I think, BHP and Rio reversing their dividend policy from unsustainable to sensible. All of a sudden, people could see cheapness in the sector when they weren't worried about balance sheets. Along we've gone from there. We saw the IPO market reopen only a chink, I suppose you would say, in 2016, and then money really started flowing nicely into IPOs in 2017. That's certainly an indicator that you've gone from 6 to at least 7. Most of that money these days is raised for exploration and development purposes for companies to build projects and find them. And we've seen those activity measures kick up. So we've gone past 8. Now, whether it's between 8 and 9 now is where you start to argue and wave your arms around. And I don't really mind. The fact that people want to talk about the clock tells me investors are interested. What we say on the clock between 8 and 10 is there's actually no indicators on the clock. So what do we see at the moment? Well, there's not a hell of a lot of M&A. Exploration's still increasing. IPOs are still increasing. People are feeling really happy about valuations. Prices are going up. I think that probably defines 9 o'clock as being, there's not much to say, so it must be. You could pick a time between there. Personally, I think we're probably still between 8 and 9, just in terms of the time it takes to get from 8 round to 10. And I think we are still so far from seeing exuberance in the sector. And I don't mean necessarily equity prices, but there's a lot of institutions which are still massively underweight. The market as a whole is still well underweight resources on historical norms. Valuations are one thing, but I think they've got a long way to push before you start to really feel that they've gone a long way. The big indices have always gone between sort of 3.5 and 9 times in a boom, and they've gone 2 times so far. So on that measure, there's still plenty of headroom. And I suspect this boom could well be driven by supply deficits rather than China coming into the market for more production. And those things are very, very slow to address. So for this boom to take place, I think there's probably still a great deal to play out there. And we say on the clock, and this confuses a lot of people, we have a sell, buy and hold phases as you go around. And from 8, you sort of go from the buy into the hold/sell. And I think that should be a very blurred line. Our graphic designer had done solid lines, and people have asked a lot of questions about that. We're nowhere near needing to sell. We're nowhere near selling. So we're still very happy to be buying things and investing.
Brilliant. Joe, would you add to that?
Yeah, my view on market timing is it's just so difficult to. It's hard to quantify the way. The clock's a great analogy, but we're a fairly data-driven organisation, and when we're running our financial models, we'll run 10,000 stochastic scenarios, but we don't actually quantify where we think we are in the cycle. We don't put it on a scale of 1 to 10. We do think about that when we're looking at our portfolios and deciding we're a little bit underweight something, or we need to be getting more exposure in another area. We tend to spend more time focusing on the assumptions in terms of operating assumptions and price assumptions as well, and to some extent equity multiples of PNAV, where do we think that should be trading in 3 years' time. But we don't focus so much on getting the timing right. We think at any point in the cycle, if you're making some fairly cold-hearted investment decisions, that's more important to keep busy, keep evaluating, and look at investments that can make sense at any point in the cycle, because it is so hard to predict where you are.
Excellent. So that's the view from 2 fund managers. What about you, Bob?
I'm going to approach it from the Canadian perspective. I think Canada's
upside down then, won't it?
pretty much. No, I think Canada's clock's a little slower. I think maybe their battery's running down or something like that. I'm not sure, but I'd say in Canada, the funding for exploration, for instance, is probably in the 5 to 6 time frame, maybe 6, 6:30. As recently as 5 or 6 weeks ago, I was talking to a broker or investment manager at one of the big brokerages, and asked him about funding a new startup in gold or copper in Canada or elsewhere in North America, and he says, "Can't put any money together for you at all, Bob. If it's not going to lithium or pot, we're not interested at all."
That's the thing, the cannabis boom in North America is really...
It's sucking money right out of mining.
Well, that and the cryptocurrencies as well. I mean, there was $3 billion raised in March for cryptocurrencies, and that's had a bigger impact in North America and Canada than it has in Australia. But sooner or later, the cannabis boom has to run out of puff. The pot boom has to run out of puff. And maybe the cryptocurrencies will disappear into the ether. I don't know. But
just don't inhale.
That's right. But so it's been tougher in Canada, and the only way juniors have been able to raise money is really get a major to take a 10 or 15% stake. And
Canadian companies are actually doing the reverse now. I'm hearing people talking about coming to Australia and for their IPOs rather than the other direction.
Yeah, it's incredible. It is incredible. And I think last year was almost the first year that the ASX raised more money for mining stocks than the TSX, although they got a bit funny, I think, when that got quoted, and they came up with some numbers that just found them just in front, as you'd expect.
Of course.
Bless the cotton socks. But so the ASX is going very well, and we are seeing that reverse migration, which is interesting.
However, I think when we start approaching 11 and 12 o'clock, everybody will catch up to the same time zone at the same time, and it'll all go into the ether at the same time as well.
Well, we'll see. So just on that, the global, just some stats, I guess the market cap of the global mining companies peaked in 2012 about 2.3 trillion. And then January 2016, which was the low, it fell down to 750 billion. And right here, right now, it's about 1.5 trillion. So it's 2/3 of the peak, but we're still sort of 34% off the high of 2012. So at the same time now, we can see the Dow Jones going from high to high, and a lot of those stocks are still overvalued or very highly valued. There's plenty of room left in the mining space. and plenty of room for corporate activity. And I think the confidence that's coming into the market with the strength in commodity prices, I think we might ultimately see some corporate moves, given there's still room for a corporate takeover premium and you're not sort of paying all-time highs. So we'll see. Now, is there a question from the floor? Over in the back corner there, Isabel, I think. If you could say your name, please.
Yeah. Hi, Liam. Richard Crooks, EMR
Okay,
Capital.
Richard. Hi.
Could the panelists perhaps give their preferred models for incentive structures for management teams, remuneration incentive to perhaps that best align the interests of investors and the management teams?
Cool, that's a good question. Who would like to have a go at that?
I'll start.
Good on you, thanks, Bob.
Okay. So incentive or compensation packages obviously naturally comprise fixed compensation, incentive compensation, and performance compensation. And so, in my opinion, and I think the way a lot of boards are looking at things these days is that the fixed compensation is, if you look at the percentiles, definitely keep it in the mid-range, 40, 50 percentile of the span, so that there's still a hunger there in terms of how much a person gets compensated on a fixed basis. The bonus is based on personal performance and corporate performance, and that can double that number very quickly. Usually the performance bonuses are 100% of the fixed compensation amount, and then the incentive bonus, which drives the person to be stay there sustainably, is usually in some sort of a stock package of some sort, typically in options rather than in fixed stock grants.
Okay. Thanks, Bob. How about from the fund managers? What do you look for? How do you like to see the guys incentivised?
I think Bob's right. I could add to that we like to see them having put real money into the company. It's not just sort of the free equity that they've picked up along the way. Like to keep it fairly simple when I'm I'm more focused on earlier stage companies, so their KPIs are not necessarily revenue growth. They're going to be more some deferred equity portions based around maybe it's an acquisition or completion of certain stages of the project, but it's generally just equity based, and keep it fairly simple.
Yeah, I got to say I'm quite attracted to the sort of vesting performance rights which are being used in Australia now. I think we've pushed that way for tax and governance reasons, and a lot of governance recommendations, I've got to say, I really don't agree with. But these which are designed to not provide a reward until a hurdle is reached, and don't take cash out of the company, which, there are stages where that's far more important. But it definitely puts the executives on the same page as shareholders from the point of view of ownership. Also like that in a few cases, there's an escrow provision on some of that, so it kind of has an anchor to it as well. And I mean, you can be fairly mean with the way you set these things up. And I've looked at this as a fund manager, and it's easy to sit there and go, well, geez, this guy's paid more than I am, and then he's getting all this other crap on top of it, and feel really, like, no, I don't want to agree to that. But at the end of the day, there's a competitive market out there for good people, and you need to be cognizant of that, because when it comes to the conversation, about 90% of that is around, I really want to work with you. This is from their point of view coming in. But the last 10%, which is usually the deal breaker, is, well, if you don't pay me as much as these guys over here, then the conversation is over. So you sort of need to know what your starting point is first. I guess, there are lifestyle considerations of what needs to be maintained, and I don't have a great deal of empathy for that. But again, that contributes to the going rate for these people. And in the end, I think providing them something which enables them to share in the success, and they're going to have to work extremely hard to get this in a lot of cases, right? So I think there's room to be very generous on equity positions and fair on the cash that they need to be paid. You need to pay them something as well. So, it's very difficult to get right, and if you are too formulaic about it, you can often miss the right people. But, as we've said before, judgment of the right person has often got a lot to do with what your personal views are, and not necessarily just the skills that they show on the page. There's a lot of personality interactions that need to take place there as well. So As far as incentives and stuff go, Crooksy, it's a pretty broad thing and probably specific to the individual as much as it is to the marketplace from my point of view.
I've interacted with a number of compensation consultants because I sit on a few remuneration committees on boards. And again, I'm going to compare Australia to Canada in that I find that on the fixed compensation side, the salary side, Australian CEOs tend to even 15 or 20% higher than the base salaries of Canadian equivalent CEOs in the junior sector.
So can I suggest that, I mean, there are sort of two models here, or there's two businesses. I guess there's the junior that you're trying to incentivise everyone, and hopefully people are going to make 10 times their money. So getting options makes a lot of sense, and it works very nicely. But then you've got maybe the mid-caps, and maybe they've had their run, and the principal's made a pile of money, taken his money off the table, and then he's trying to incentivate his new executive team. And they've got mortgages and school fees to pay. And I just don't know whether there's a stalling of initiative or their appetite for risk changes. It's all right, I guess, when you've formed the company and you've made your pile of money, but when you then get in your next layer of management team and they've got all these, they don't want to blow it up and they don't want to jeopardise their bonuses, or they might have $5 or $10 million in performance rights, but they can't really get out. They can't sort of exercise and sell, so they're sort of trapped. Yeah. And there might be some innate conservatism which comes into running the business rather than taking a game-changing, or to take the company up to the next level to buy a cow and put it all on black necessarily. And so I'm not sure whether it's one size fits all. And as they get into these mid-caps,
it's definitely not one size fits all.
You need to tweak it, because I don't.
And then, I mean, you see at the top end of the scale, there are enormous cash compensation packages being paid. And I mean, we saw this in the news. Elliott, the group from the US, taking BHP to task on how well or otherwise they deployed capital through the phases of the cycle. And when you reflect on how much some of those individuals who'd presided over those decisions had taken out of the business as cash remuneration, you just sit there and feel sick about it as an investor. So, as it magnifies itself as you go up that tree, and the biggest rock star in the world needing to be paid the highest amount of money, it just gets ridiculous at that level. So I'm not sure an equity package would really solve that, but I would say that there are parts of the industry where it's definitely a miss.
Agreed, and I think I have, as a barometer, I think when the big guys, the BHPs and Rio Tintos buy, it's time to sell, and when they sell, it's time to buy. I think you do that, you'll do all right. No disrespect to anyone that's here, Rio. Okay, next.
That's general advice, isn't it, Liam? Sorry? That's general advice.
That's general advice, exactly. Thanks for saving me. Joe, do you have a vision of management teams of the future, and what aspect are you personally or most interested in?
When we're looking for management teams, I'd say we focus equally on boards just as much as we do on management teams. We're looking for the diversity of thinking that has been touched on before. So you don't want to be too overweight on any particular skill. Production experience versus exploration, obviously depending on what the stage the company's at. So we look for a balance. I personally think we need to see better communication skills from leaders in the industry. I mean, the industry is solving technical problems. I mean, how do you find and extract? So 2 parts per million gold is a technical problem, but it's a people problem. Is really how do you go about getting the best outcome? And that's the challenge of management, is how do you bring people together for really good things to happen. So I think I'd like to see that as something that management teams, I'm drawn to management teams that are really able to communicate well with their various stakeholders. And I think for the future, embracing technology is, the mining industry is open to technological change, and there's a lot of opportunities out there. There's a lot more sort of technology in the toolkit. So I think being able to embrace that's a big competitive advantage and great for investors.
Yeah, well, I think the new technology, I mean, it's this communication issue is a big one, and we've got the Greens love the electronics, and they love the the batteries, but they think they come from butterflies and unicorns. They don't realise there's actually mining involved, and they've got to get behind it. And I think it's incumbent on us to sell that message a little more effectively.
I think there's a fair few politicians might think that too, except when it comes to putting royalties on it, and then they know it comes out of the ground in their state.
Perfect. Excellent. Okay, so now I guess, Hedley, those companies that I referred to that have made those once-in-a-lifetime acquisitions over the last few years, and they've been materially re-rated, enjoy strong valuations on the ASX, but find themselves in a small but crowded pool. Have they reached their limits in Australia? And do you think will they need to look overseas?
I don't want to say anything incendiary, but there's not a hell of a lot left in terms of assets which appear to be available for pulling out of big companies, built things. Look at where they've been successful. And if you compare Northern Star and Evolution in their early days, I mean, Northern Star was Paulson's, which has been a shining light for them, but that's because they've operated exceptionally well. And they've had the luxury in recent years of enough cash flow to sort of, put it to one side for a minute and think about it. If they were a single asset company with that asset, they would be in a lot of trouble now. The first thing they bought was Plutonic, and that certainly didn't shoot the lights out, but it gave them a breadth of capital and breadth of cash flow, breadth of operations to be able to deal on bigger things, which is what we touched on before. So their bigger acquisitions were coming out of stressed majors, and they were taking a view that they could operate it better, I'm sure, and also that they could invest in the future of that asset in a different way to the major and what they were prepared to do, so that they could explore it, expand it, add life to it, etc. There are still assets owned by majors in Australia which you could probably transact on, but I suspect the price has gone up as the sellers are no longer nearly as stressed as they were. And whether or not the opportunity has changed as a result of the price tag, I suspect it's probably gone away on a lot of those things. So they need to look to their peers. Would they ever buy one of those? And I think they would all sense that at this stage that would be a difficult proposition based on what their peers' expectations would be. And they've got shareholders breathing down their neck. It's a bit like, my middle son is very good at this. When he's had a week or so of not stuffing up, he sets the table and he clears the table, and it's like golden child moment. So these guys haven't done anything wrong for quite some time. And speaking as an industry as a whole, they had a bunch of bigger brothers and sisters that went before them who were some of the biggest screw-ups ever. I mean, you look at what BHP and Rio had done to take us into the peak and the massive value destruction. So these guys have been able to do the opposite. Now, put the shoe on the other foot there, and when my son has had a bit of a rough week and we're getting stuck into him about stuff, he takes risks. So he gets on the football field or the basketball court and he plays aggressively. He goes for the ball when he probably should be sticking to his player, but things come off, and as a result, so I don't know what I prefer, the better footy player or the kid that just sets the table and shuts up. I would say that a lot of those groups are now in that shut up and set the table mode, as opposed to take a risk and go for the ball because you can see that it's there and you know that it's there, and they're thinking, well, we've done that in the past, but we don't actually have to now. Going offshore for them is going to be a massive paradigm change, and it doesn't matter whether it's in the time zone or whatever and you think you can manage it. The market thinks that Australia is a great place to be. I mean, Joe's recollections, etc., from the Canadian market, I think are telling you that there's a lot of money coming into Australia from all sorts of places overseas which have placed a premium on it. So if you're enjoying a premium, your day in the sun, you're still getting your assets improving, why the hell would you break that recipe? A time will come where they need to, but I don't think we're there quite for them yet, and I'm sure they'd be looking, but reticent to move on something unless it is superb and cheap.
Great,
Brad
great
Pitt,
advice.
so to speak.
No, that's very good. Joe, would you have anything to add to that?
I'd say go offshore. Australia is only 5% of the world's surface area, and the Aussie rocks punch above their weight, but I think you've got to be looking offshore, emerging markets. There's just a lot of opportunity out there, and that's probably where the future is, I think, for a lot of Aussie companies.
I think they should too, Joe. I just don't think they are feeling that way at the moment.
Yeah, I think there are times for asset acquisition, then there are times for consolidation. And it appears in Australia that the asset acquisition part of the cycle has pretty much played itself out, and you'll see, I think, consolidation of juniors to become mid-tiers or mid-tiers coming together to become the next major and that sort of thing.
Well, one could think, I guess, now with the Canadians a little bit on the back foot, I mean, their junior sector and mid-caps are struggling. Now would be the time to buy stuff overseas when you haven't got a Canadian breathing down your neck trying to pay, 10, 15, 20% more than you. So, but it's typical, there's still, as Hedley's saying, there's that reticence, or let's stick to what we're good. We're making very good money here. Shareholders are happy, great dividends, don't blow it up.
Yep.
Yeah.
I mean, I can imagine if one of them went off to Africa, their shareholders would be like, what the hell do you know about Africa? And the whole argument of, but it's cheap, we know we can do it, and it looks great, it's going to add a lot of cash flow, will be lost. Because it'll all be in, well, just wait a minute, you were setting the table a minute ago, and now you're out kicking the footy. So.
Look, thanks, Hedley, and thanks, gentlemen. It's been an excellent session this morning. I really enjoyed it. It's been an absolute pleasure to be the moderator here. And could you please put your hands together for the panellists? Thank you.